Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books. Well, today we're talking about Disney losing billions on their direct-to-consumer streaming services. It's normal for a company, if they're going to spend a lot of money and launch a project like this, that they could lose, money getting it going. But Disney just recently did their recent earnings report, and it's more. It's more than expected. They've lost quite a bit of money. This is a quick chart just showing Disney's streaming losses so far. While the Hollywood giant disclosed on November 8th, 2022, that a total of 235 million combined subscriptions to Disney+, Hulu, ESPN, and Hotstar, that growth has been coupled with accelerating costs. Leadership expects losses to peak in fourth quarter of this year. Now, one of the things people also don't know about Disney is that when they sell their bundle, that one bundle is reported as 3 subscriptions. It's an accounting trick. You're getting counted 3 times because they have multiple streaming services in the bundle. The point of that is that's part of what the 235 million subscriber number is. That's how they got such a high number, because it's 40% of the direct-to-consumer subscriptions are actually in that bundle. This most recent loss of 1.47 billion, I mean, you can look at the losses and combine them and say, well, wait a minute. How is it that they're losing so much money operating such a successful streaming service? And again, it does cost money to start things up. So the problem with Disney is not that they're losing money on streaming. The problem is, are they losing more money than they projected they were going to lose? And if they're so successful with 235 million combined subscriptions, why would you not be losing at least less money than projected? Because now they're losing more money than projected. And as far as the stock market's concerned, experienced analysts are cutting their stock by anywhere from, at the low end, say 15%, a full 30% and more. And, these guys have seen a lot of things. They know that streaming is kind of a unique thing, but it's not that unique. And basically, it's gone into more of a mature phase where it's like, you've got to actually have numbers that make some sense. There's a lot of funny accounting things, just like the streaming bundle, where content goes onto a streaming service. How many years do they say when they spend money on producing the next She-Hulk show or the next whatever they're doing, Werewolf by Night, all the content that they're doing, how are they allocating those costs? When they're doing these Star Wars shows, all the new Star Wars shows, and you get to the point with Andor where it supposedly is even a good show, but people don't even feel like watching it. They've watered their brands down so much. You put the content on the streaming service, okay, and now you're saying, all right, well, we lost 1.47 billion this quarter on our streaming services. All right, well, how much of that was content? How much of the spend was content? How did you allocate all those Star Wars shows? Are you saying that they can be watched for 20 years, so you're going to stretch it over a 20-year time period? That is the kind of thing that's done when you've got a response from the market. You make adjustments. This is an accounting thing, but funny stuff seems to be going on, at least from where I'm coming from, where I'm looking at it, I'm saying, I don't know how they're allocating their costs, that they even came up with this 1.47 billion. They do give some information in their reports, but it's not enough that you would know. Kareem Daniel, who's the head of distribution for Disney, they restructured all the distribution and put it all under Kareem Daniel to make a decision of what market they're going to offer what shows in, whether it's going to be on regular TV or on cable channels, or if it's going to be through the streaming service or theatrical. He's not the sole decision maker, but he's in charge of that department that makes that decision. So he's quite important. He recently said in an interview that, as far as canceling future Disney Plus shows, because someone asked they're interested, we're not looking at canceling anything right now because we're just putting content of our library on the streaming service, and we have that library forever. And that's fine, but what that tells you is there's something up. I think these losses are probably much lower reported than they actually should be. Because when you look and you say, well, what's the streaming service's success rate? How is the viewership of She-Hulk? It's number 1, isn't it? Like, no, it's not number 1. It didn't even rate on the Nielsen's. They're also, should we trust you when you say how many years of value you're going to get out of She-Hulk? Because here, this is from Comic Book News, he does a great job of just pointing to parent analytics, like Nielsen, that gives you ratings and tells you what's successful, what's not successful. Well, I wouldn't have known this, but thanks to Matt, I do. Parent analytics shows that Disney Plus actually skews towards males. Peacock, Hulu, Apple's TV Plus, Paramount Plus, Netflix, Prime Video, all of them skew female. Why are they making these female power, female-centric shows on Disney Plus if that's not what their market primarily is? It's obviously going to affect their ratings. You have to look at it and just say, like, how much trust do you have for the Disney management? A good way to decide, like, how much trust you should have for the Disney management is listen to what they say, judge their sincerity. Do they seem like they really mean it? Take all of their assumptions as correct. What do they project is going to happen? What do they say is expected to happen next quarter, next year? And then when things come to pass, judge them based on that. Analysts are pretty sophisticated. I am not a finance analyst following Disney, okay? There are people that do this for a full-time living. They're very careful. They evaluate them against what they've said, against public information, sometimes against non-public information, specific research that they do. They spend a lot of money analyzing these companies. If they say, we expect that Disney is going to such, and Disney falls outside of those projections, that's a big problem. That means there is just fundamentally something wrong going on at Disney, which eventually, unless they grow incredibly magically successfully, that junk that's being hidden is going to get uncovered. Okay, let's get into this Hollywood Reporter article. There's some good specific information, and I like how they've organized it. Before we do, please be sure to subscribe to the channel. Click the bell for notifications. Give me a thumbs up when you like it. I really appreciate you guys. The channel's doing great. It's all thanks to you, so I sincerely thank you for that. Thank you so much. Disney Plus growth doesn't outweigh streaming losses, pay TV challenges, as analysts cut stock price targets. That's the problem. The Hollywood giant stock fell on Wednesday as Wall Street reacted to its latest quarterly results, including streaming losses and the impact of cord cutting on the traditional TV business. When they say cord cutting and the traditional TV business, they're talking about their cable channels, and Disney has extensive cable channels. Subscriber growth is nice, but not if it comes with big streaming losses and a fast declining traditional TV networks business. That was the message that Wall Street sent Hollywood giants yet again in analyst reactions to the latest quarterly results reported by Walt Disney Company late on Tuesday. The stock was down about 7%. Financial observers cut their earnings estimates and stock price targets while also mentioning positive streaming subscriber trends. After all, Disney Plus added 12.1 million subscribers at streamer Disney Plus in the fiscal fourth quarter ended October 1st, which included the launch of such originals as She-Hulk Attorney at Law and Andor, two properties, right, Marvel and Star Wars, that really have lost their luster under Disney. It makes you wonder. Bringing the streamer's total user base to 164 million. Wrapping up earnings season for industry majors, Disney also reached 236 million overall streaming subscribers. The direct-to-consumer or streaming unit recorded a quarterly operating loss of 1.47 billion, more than double the 630 million reported in the comparable period of 2021. More than double? They've had a whole year of all this growth. But again, these numbers, 36 million overall streaming subscribers, wonderful. First of all, a big percentage of those are multiple subscribers. One subscription to a few services that are heavily discounted. The bundle is cheap. Disney's stock fell sharply in early Wednesday trading. As of 9:40 Eastern Time, it was down 10.7% at $89.22 after earlier hitting a new 52-week low of $88.40. Guggenheim analysts, so Guggenheim is one of these financial analyst companies that people pay for research, so they can make investments based on expert advice. Michael Morris maintained his buy rating on Disney, but slashed his stock price target by $30 to $115 in a report entitled, "These are not the results you're looking for." Quote, 1 quarter removed from strong profit growth and an upbeat outlook, Disney's fiscal fourth quarter revenue of $20.2 billion and segment operating income of $1.6 billion were below street expectations of $21.2 billion and $2.3 billion. Below expectations. Global SVOD, that's subscription video on demand, Netflix, Disney Plus, HBO Max, subscribers showed healthy growth as we expected, while DTC revenue and operating losses weakened on foreign exchange headwinds and a mix shift to lower average revenue per user, bundle, and promotional uptake, which we've been talking about. So essentially they're lowering prices because they're putting them in these bundles. They get these high subscription numbers, but you have to look at like, well, what's in like countries that are Western countries? Not what do you have in India selling incredibly cheaply because it's a much lower based income. But you can easily be deceived by them saying, oh, we've got all these subscribers all over the world, global this and that's. Like, okay, fine. What's the revenue really? And it's down. It's beneath expectations. The other thing is you have all of these subscribers. Of these losses, what percentage of this loss of 1.47 billion is cost of acquiring customers? Because content gets customers, absolutely. You spend money on making shows. That's a cost of doing business, but also promotion. Discounts are promotion also, but direct spending on marketing and promotion to get subscribers. That costs money. It's fine that you spend that money, but is it profitable? That's the issue. I keep clicking accidentally on Zaslav here. I did a video on this a couple of days ago. Zaslav destroys Netflix. This is just basically on Warner Brothers Discovery's recent conference call, and they have their absolute challenges as well. But strategically, what they say at Warner Brothers Discovery, what Zaslav says is like, hey, listen, we're not going to pursue getting subscribers at the expense of being profitable. We're also not just going to put on tons and tons and tons of content on streaming services and add content and create new content because they already have more content than anyone else. They have a lot more content than Disney does at Warner Brothers Discovery because of the history of Warner Brothers. They could have much more aggressive subscriber growth if they wanted to, but they choose not to spend the money to try to make that happen. They're trying to make a truly profitable business. Disney is still aggressively trying to grow subscriptions, and they'll spend anything on content, apparently. They're cutting back on some of the new Marvel shows, but they're spending a fortune on things that people don't even really like. Management's 2023 outlook smacked down on the bull case on the total company revenue and profit growth in high single-digit percentage versus preprint consensus of 12.5% and 32%. Our lowered estimates primarily reflect greater direct-to-consumer losses and slower theme park profit growth than previously forecast. Well, they're not hitting their numbers. And we all know at the theme parks that they jacked prices up to the point of ridiculous at Disney, much more than Universal did. All right, let me know what you think of all this in the comments below. I always like to see your comments. I try to read every one. I try to comment on as many as I can. And please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. And I will see you again soon with another video. And if I don't see you, I will miss you.